This trade was executed based on algorithmic trading principles, and the strategy utilized insights from price action, institutional order flow, and fair value gaps (FVG) to inform the decision-making process. If you want to learn algorithmic concepts, please watch videos of ICT on YouTube, who was my mentor. Algorithmic trading basic concepts. The idea here is that the price of the underlying is controlled by an algorithm which aims to match the orders of buyers and sellers. The algorithm seeks liquidity, which are orders placed by market players. Now if we look at where orders will be, it will be below old lows or old highs. These could be stop-loss orders or limit orders. The retail traders' orders are small compared to orders of big institutions that have to hedge their foreign exchange exposure. These institutions have forex hedges, and when their hedges are profitable, they move their stop-losses to just below a major daily swing low. As the algorithm seeks to match the orders of the buyers and sellers, these old lows and highs are what the algorithm targets. For example, the current trend of GBP versus USD is bearish and the price is very near the daily swing low. So it is reasonable to assume that the algorithm will target this low. Then we have the FVG. These are called fair value gaps by ICT. They are just imbalances in the candle. We can see it on the daily chart as shown here. The imbalance is a body of the candle which has no wicks on it. In order to match orders, the algorithm also goes to an imbalance. You might wonder, why should the algorithm go to an imbalance to deliver orders? If you look at the lower time frames, you can see old highs and lows within an imbalance. For example, on this GBP versus USD chart, if we look at the 4-hour time frame, there are 4-hour highs just below the imbalance that we see in the daily chart. In algorithmic trading, these FVGs act as support and resistance. We can see the FVG acting as resistance in bearish conditions. In bullish conditions, the FVG will act as support. So if we know that the algorithm will go to an old low or high to seek orders and the FVGs will act as support and resistance, then all we need to know is the trend, and then we can use these principles to take trades. Using all these, let's try and frame a trade on GBP versus USD. This is the daily chart of GBP versus USD. Here we can see the price went up and then has come down. The current trend is bearish. The price is near a swing low formed last month. The swing low is at 1.3010. So from an algorithmic perspective, we know that there are orders below that old low at 1.3010. The price is in a clear downtrend, and if we see the 4-hour market structure, the trend is bearish. Here we can see the FVGs outlined as we are in a downtrend. The FVGs act as resistance. You can see that on the lower FVG. The price was unable to go above the FVG. Let's now go one time frame lower to the 1-hour chart. Again we have drawn an FVG which has acted as resistance. So going into the CPI, we were looking at potential targets that the algorithm will seek. The most obvious target was the old low at 1.3010. Now we will introduce the time and price concept. According to ICT, there are certain times that the algorithm is particularly active, and the algorithmic concepts are more likely to be valid in these times. These are the London Open Kill Zone 7 a.m. to 10 a.m. London time and the New York Open Kill Zone, which is 12 p.m. to 3 p.m. London time. Let's see what happened in the London Open Kill Zone in the 15-minute time frame. At the London Open Kill Zone, the price went up to form an equal high after touching the order block at 1.3085. The order block is the last up move before the move down. There are plenty of YouTube videos on order blocks. So if you are not sure what it is, I would advise you to look at those videos. So if you look at the daily chart, the 1.3085 level was drawn from the last green candle before the move down. The price will be sensitive here and will act as resistance. So our trade idea was to set a limit order about 5 pips above the order block and use the FVG as resistance. The trend was bearish and our target was 1.3010. The stop loss was above the FVG at 1.3120. At the New York Open Kill Zone, the price makes a false move out and raids the equal highs. The retail trades see this double top as resistance and put their stop orders above this. The algorithm raids these orders before going to the intended direction. Another telling evidence is that the price immediately reversed after raiding the equal high in the New York Open Kill Zone. You can find many examples like this if you study the chart. Here is another example of a trade that we took on gold. This only shows the 15-minute action on gold. But the daily chart showed structure break and had bearish potential. The price was in consolidation. However, on the 15-minute chart there were equal highs formed, which was raided by the algorithm at New York Open kill zone. We entered short after the structure break and gained 34 points in gold, which was shared in LinkedIn. I hope you found this video useful and insightful. Thanks.